provide information about new topics and expand your knowledge base. But another reason that we do them is to help you build your network and connect with other people in this space. So I'm going to do like a quick little round robin of a few of the people that I've chatted with and who I've noticed online, just so that you know who else is in the room. And we really encourage you that after this session, we'll have some time where you can ask our speakers some more direct one-on-one questions, but we also encourage you to network with each other and get to know somebody new. So if you could walk out of the room knowing one new person in the ecosystem, I think that would be really beneficial. So we've got Climate Tech Incubator people, me and Warren back there, and you might have met Nicole, who is working with us up at the front in the registration. We also have some of our Climate Tech Incubator founders. So we have Ariadne here. She's with P3RD. A startup that's based and growing here in Maine. We've got some of our mentors online. We have some Northeastern University students here, RU Institute students. We also have online Maine Redevelopment Organization. We have Maine Biz online, which is really exciting. Climate Advisory. We have Wilmington Trust. Thank you for all of your support. Gulf of Maine Research Institute. Any other, we've got Shred Electric, another Maine-based startup. Roe Westbrook, so if you need a new EV car. Anybody else that I didn't mention? Yes, I literally wrote this on the side of my paper and I didn't read it. So we have New England Environmental Finance Center that is helping with operational sustainability for breweries, hotels, and other tourist organizations. Really cool organization. I think some of your colleagues are online as well. So anybody else that I missed? Dan, I can never remember your organization. Excellent. And I didn't meet you when you walked in. Awesome. Well, I think that could be an interesting connection right there. Excellent. So if you guys want online, if you want to put just a little intro in the chat as well, we hope that this becomes a good networking opportunity for all of you. We have some bathrooms in all of the horizontal hallways and water refill stations. We have snacks up here. We're very casual in person. So if you need anything while you are visiting us, please don't hesitate to make yourself at home. And I'm going to turn it over to Elizabeth to introduce E2 Tech.
So thank you, Tara, for introducing a little bit more about the RU Institute and the Climate Incubator series. Again, this has been an ongoing partnership with the RU Institute and the Governor's Energy Office, and it's nice to see so many new and familiar faces here today in person and online. A little bit more about E2 Tech, or also known as the Environmental and Energy Technology Council of Maine. For the past 20 years, we've been leaders in the building and expansion of the state's clean technology, environmental, and energy sectors. We do that by being a membership-based organization. So right now we're an organization of 4,500 plus members with 225 plus member organizations and 50 plus sustaining member organizations. A big function of what we do is building connections across professionals and experts in various fields across the state, as well as with startups, and really building those success stories and networking opportunities. So if you are ever interested in potentially becoming a member with us or have an event idea, please get in touch with me so we can try and make that happen. Lastly, you might see some of these flyers at the front desk as well as by the snack table today. And this is about our Remain internship opportunity. And it's part of the Governor Energy's office programming to try to build out 30,000 clean energy jobs in Maine by 2030. It's a 50% subsidized internship program that lasts 8 to 12 weeks and is focused on bringing renewable energy interns and especially young Maine professionals into these fields. So if you're also interested in potentially having a Remain intern, please let me know and I can put you in touch with the Northeast Energy Efficiency Partnership. I'm going to pass it back to Tara now to introduce our panelists for today.
Great. Thank you so much. I'm going to switch the screen so we don't see people popping in and out, and we have a few less distractions here. Maybe. I think I need to push a button on this keyboard to escape. Sorry. Okay. Right, now we've got a nice little background. I'm going to give you guys a microphone to share. And I'm really excited about this, this event today because just personally, I have tried to spend as little time as possible thinking about insurance. And I always thought that I found it dry and it was just like this necessary thing. And if I could spend as little time as possible on it, that would be great. Then last year at the Blue Ventures investment event, I heard Dan Bookham talk about insurance, and I put my computer down, I put my phone away, and I actually listened. And I was very surprised by myself. But he's a very compelling person to listen to about insurance. I think that's part of it. But also, insurance is way more important. It's not just an essential thing. It's part of risk management. It's something that can make or break a business. And this is very important for all of our startup members as part of the Climate Tech Incubator. I think it's very important for all of the environmental firms that are members of E2 Tech, any small business, and us personally. So I'm really hoping that everybody pays a little bit more attention and learns something today and realizes that there's a lot of really important things about insurance and interesting new ways to think about it. So before we get kicked off, can both of you introduce yourselves and tell us a little bit about who you are and why your work touches, I mean, we know why your work touches insurance, but Blaine, if you could share a little bit about why you and Dan are friends, that would be great.
Yeah, you want me to start? Okay. Yeah, Dan's much more obvious than I am. I came because Dan asked me to. And I would actually agree with you, Tara, that part of what has gotten Dan and I to be talking a lot is that I had the same experience when he and I have talked about the intersection between sort of oceans, climate, and insurance. And I find Dan's perspective very compelling. And so when he asked me to come join him, I did. So I have been for the last 20 plus years working in the ocean environmental space. I worked at the Gulf of Maine Research Institute until just a couple months ago, and first in the role of fundraising and development communications, and then for the last 6 years, created a ventures team focused on startup companies really in the blue economy, which is where Dan and I have crossed paths. About a month ago, I started my own consulting firm and have stepped out to really continue to drive blue economy opportunities here in the state. So I work with folks who are starting companies. I also am a partner in a hopefully emerging venture fund called Bold Ocean Ventures. We're in the process of raising capital to invest in companies across a few sectors in the blue economy. So that's me, I guess, and I am here, or I'm interested in this because of how it touches the companies that we work with on a regular basis. But actually, I think an angle that I'd like to take is to describe some of the emerging startup companies that are coming out in this risk management space. So maybe Dan's more of an expert on why a startup company or how a startup company would engage with insurance. I'm going to be more, have you thought about these kind of tools that might be usable either as a larger company or a startup company. So.
Thanks, Blaine, and thanks everybody for being here, both in person and online. My name is Dan. I've been in Maine 30 years. I come from an island from the far eastern side of Casco Bay called the UK. So I apologize as well for a couple of things. One, I do have an accent, and when I get excited about a topic, I start talking fast. So I expect all of you to be audience participatory and yell, slow down, if I start really going off at 900 miles an hour. It's a curse I carry. So I've been in the insurance and risk management business for about 15 years now. Prior to that, I worked in economic development, and my path into it has been through coastal Maine and a lot of marine exposures. So my company, Allen Insurance and Financial, is 158 years old. We're based in Camden, always have been, headquartered up in the Mid-Coast, and our company has kind of grown with the marine exposures that Maine has experienced over that same time period. So we started out with 6-masted wooden schooners and at the anchor foundry in town, and folks doing ground fishing in the Gulf of Maine, and have transitioned into the tourism and experiential windjammer universe, fishing fleets where New England families have spread throughout the waters of the United States. I've got 5 boats currently working in the Bering Sea. We're a Maine-owned company that are Amendment 80 fishing boats that are facing some really interesting issues with weather and climate of their very own out there. And we work just almost by happenstance more than design all across the country in all manner of industries. But the one thing that we found, and I found in particular, that pulls them together is this continual impact of external forces on risk. And that's really where my interest in climate and risk comes about, because there are elements happening that are beyond our control that are going to have a real impact on the bottom line. And we have to figure out how to both face that and mitigate that if we plan to be successful.
Thank you. You just reminded me that I should probably talk about what we're going to talk about for the next 45 minutes or so, which is a lot. So we're going to talk about the changing nature of insurance coverage. So what are these external factors that are influencing a lot of climate issues, influencing insurance? And specifically climate change on insurance, and then innovation in data and how both of these things can help advance the insurance industry, and then what should people think about when they're securing their own risk management through insurance. So we're going to try and cover all of that in 45 minutes. Then we'll have time for question and answer directly, and then also networking question and answer a little bit more informally. So my closest brush with insurance is I'm a Floridian. We just went through 2 horrible hurricanes last year, and a lot of small businesses and individuals realized that they did not have flood insurance because they have never been in a flood zone before. Then they were completely flooded. They had no insurance coverage. And now they find themselves in a really terrible place, and a lot of businesses in my town have closed, unfortunately. So many, I think, small businesses are very cautious about funding, but also early stage startups. They're operating on these very lean budgets, and just see insurance, like I said at the beginning, as this extra thing that they have to pay for that probably doesn't concern them. I'll worry about it when I have revenue. I'll worry about it when I'm bigger and I've scaled. How should early stage startups or small firms think about risk even before they're generating revenue?
That's a really good question. Kind of gets to the crux of it, doesn't it? But I think just a note on that and how people think about insurance or risk and these kind of things. And I'll admit it, I'm in the industry and it's boring as heck, man. I mean, it really is. And it's about an abstract, right? So insurance exists to do something and you hope you never have to use it. So that's an outlay going out that is, we're not going to give it back at the end of the year if you didn't have a disaster. You got through the year, everything was fine, and we've funded our operations from that and made hopefully a little bit of profit on the back end. And so it looks like an outlay. And paradoxically, if you have a run of good luck and good operational stance, you're not going to need us very much. So you're going to pay for it, and the money's just going to keep going out the door. So there's that one mindset piece as well. The second thing we face, and I will argue that our industry is its own worst enemy, in that there are what we call these rating companies and there are insurance companies. And the rating companies are the ones you see advertising all the time on TV, right? 15 minutes will save you what? Right, there you go. So a great illustrative example of how these companies, these national companies that have commoditized consumer level home and auto insurance, is when Aaron Rodgers, he was quarterback for the think he was for the Packers at the time, and he lied about his vaccination status, right? So they suspended him from the league. Aaron Rodgers was a spokesman for State Farm Insurance. Anybody want to hazard a guess how many commercials were pulled on one Sunday off all networks, all platforms, nationwide, cable, broadcast, online, featuring Aaron Rodgers during the football season when they suspended him? That's a correct answer. I should have specified in terms of, as opposed to a percentage, a number of commercials. 20,000. So that's the messaging with one company on one day, talking about insurance being a commodity, something you get for the cheapest possible price you possibly can. And isn't it funny, there's a lizard, there's a lady in an apron, right? So what our industry hasn't done is a good job of delineating the difference. That's fine. You can buy your car insurance there if that makes sense to you. I wouldn't necessarily suggest it for myself, but we can talk about that afterwards. When it comes to a business, when it comes to the enterprise risk that you face, you really want to spend a little more than 15 minutes on it and be thinking about less about, am I going to save 15% or am I going to save at least the other 85% of my business if I have a disaster? And so I think that's a large part of how you have to go into this. And we a lot of times get asked about how much insurance should I buy? What type of insurance should I buy? And the glib answer is, well, you want to buy the insurance of the stuff you have that you can't afford to replace out of your pocket tomorrow. So that's your property side of things. It could be your equipment. It could be your inventory. It could be your, if you're lucky enough to own the building you're in, that could be a factor as well. What is your intellectual property exposure? You got to think about that too. Can I afford to cover that? If I've got a whiz-bang fantastic idea and some large company is going to come and try and sit on my chest, do I have the scratch to fight that, or can I get an insurance policy to help me? What happens if I mess up, right? It could be professional advice. Do I have coverage if my advice to a client causes them to lose $1 million? Do I have $1 million to give them in return or defend my reputation if they make a false claim against me? And if someone trips on my laptop cord, can I afford to pay their hospital bills when they come after me for that? So those are the kind of questions you've got to ask yourself is, what are the threats to my business? What are the things that are going to stop me doing what I want to do? And what's the most cost-effective way I can think about planning for that? The good news is, and there's a plug for my distribution channel as opposed to my company, the independent agent channel, especially in Maine, is really strong. These are folks who have oftentimes started their own businesses or have come up in small businesses. They understand what it means to do that, and they understand what it is to be an entrepreneur, and they can help you navigate, and the good ones will help you navigate it for the lowest cost possible. I always say, when we go through a renewal cycle, we're probably one of the only professions that actively tries to cut our revenue because we're always looking for the best possible premium available. And that's kind of the culture of the industry. So long answers, a lot of information, but essentially, if you're early stage, if you're startup, if you're just getting going, at least have the conversation. And if you can't afford an insurance policy, start sticking $100 in the bank every month to at least mitigate the exposure.
Yeah, Blaine, what do you see as you've worked with many, many startups? Do you have any horror stories?
Yeah, I have a couple. So I can not tell you what kind of products to buy, but I can tell you that if you aren't thinking about it, I guess the thing that I think a lot about, our former chief scientist, Andy Pershing, from many years ago, he used to say, he's a climate scientist, he used to say, we're living in an era of surprising surprises. So what we have been experiencing, and I think all of us recognize that who've been around and paying attention to what's happening environmentally, we're seeing large events that are affecting us all, and they're larger or more surprising than we had expected. They last longer, they have more impact. Certainly the storms that we had, that are very, all of us recognize the storms we had last year. We had two, what are they, more than decadal level storms 2 days apart. So an example, we have a startup company that we were working with that's doing aquaculture and had algal tanks that were trying to be sustained. And he had for a month, generators going out with water coming in and basically flooding his facility. And this is, a small, very tiny, 2-person organization. His entire future business, he's an oyster grower, entire future business was based on the algal supply that he had just purchased with a fairly substantial loan and some investors to basically build his business. So his entire projected future and the entire inventory for the oysters he was going to grow were being affected by the fact that the tanks were maybe not going to be, that the algal bloom would be failing. So there's an example, and we have folks like even at Union Wharf, which GMRI purchased a few years ago. We had problems with getting insurance renewed. So we have 14 businesses there. You do it was a larger organization. We did projections on what the long-term value of the property is and how we're going to actually sustain it and maintain it. And we think about our revenue that way. And then if you have storms like that where you have water coming up, not just over the top, but coming up through drains, it changes where are your central utilities. So if you're buying a piece of property, if you're renting, or if you're those businesses on that wharf and water's coming up, you really need to be thinking about where your essential equipment is. So it's maybe not even the insurance you buy. And then it's also physically where you've located the things that are valuable to you. Where are your computers? Where's the electrical outlets in these older warehouses that you're decided to locate yourself as a startup? How likely is it that things are going to happen, that you're going to be cut off from a supply chain perspective? So there's lots of things like that happen. And I think, yeah, I have untold number of examples of people having problems, especially the last couple of years.
Yeah, this is excellent. You just tapped on something that I think we can answer from two different directions. So as these people are thinking about how to do this on a shoestring budget, what are some creative ways that we can mitigate risk, both from the insurance angle, but then also, like you said, like put your computers not on the floor?
I know. I mean, there's some basic fundamentals that you don't think, some stuff you just don't think about, but you do have to think about what are the things that are your most valuable assets. What would happen if the supply chain that supplies you was disrupted? What would happen if you couldn't get down the road where your equipment is, or you couldn't keep the lights on, or, the things that we don't think about except for, in storms. These storms are happening, or these incidents are happening, and they're happening when the weather is not like this outside, by the way. We're seeing king tides here. We know, some of you guys know the Commercial Street area. If you go down by Jay's Oyster Bar on a king tide day, or full moon king tide, you will have water up over your tires. There are people trying to park to go out to the islands that are having salt water, who don't know about it, up to their doors. So there are things happening that we need to be paying attention to. And I don't know, I was going to ask Dan if you've seen this. I saw an article maybe yesterday or day before in the New York Times that there's some folks who are now doing a sort of climate smart house purchasing software. So like, or even just basics, like before you go buy a house, there's like a list of things that you should ask yourself. So I would say the same is probably true before you go sign a lease. Like, what are the possible risks of that piece of property? And then how do you think about sort of practically keeping your business running in that location? So.
Yeah, I mean, that's an excellent point, is that kind of pre-planning and sort of trying to future-proof yourself and your business. Really go wild. Sit down with a pen, paper, and kind of list out the craziest things you can think of, and then work back in from there, right? So it is kind of fun, right? Godzilla attack, probably not going to happen. Flooding on Commercial Street, pretty fairly frequent occurrence. So as you start thinking about where you want to base yourself, where you want to put your assets, and how you want to protect those assets, that's a really key process. And the other thing to bear in mind, though it sometimes tests our patience, insurance agents will talk about this stuff all day long, and they don't charge you for a conversation. So find as well as part of your team, alongside the folks who are advising you on legal matters, on consulting, on accounting, on investment strategies, on your mentor in your entrepreneurship program. Find a friendly local insurance agent and ask them questions about risk management. How do I do this? What should I be thinking about when I sign a lease? Oh, by the way, read every lease, read every agreement you sign. You could be eager to get that first contract in place. Read it. And if you have an insurance agent, give it to them first before you sign it, because a lot of times there is risk transfer language in there, especially with larger corporations, that's pretty boilerplate. I'm not going to pick on them for any reason other than I know their contract by heart. But Whole Foods, for example, if you're in food or beverage or commodity process with Whole Foods, their standard contract requires $2 million in general liability, and with product liability included, no contractual liability exclusion. And you sign that all day long, and 3/5 of insurance policies for small businesses aren't geared to address that. So you want to make sure you're talking to your agent before you execute these contracts, before you get into these leases, to make sure that there isn't language in there that you've just signed up to and is legally binding that you're on the hook for, not your insurance company, because you haven't properly considered what the exposures are. We always talk about this with lawyers, especially when they draft. I'll read paragraph 11 on page 4. I'm not going to tell you anything else about the lease. I'm going to read the risk management and insurance language because that's what I'm qualified to do. Conversely, depending on when a lawyer graduates from law school, it tells you, based on the language they put in their contract, how much they understand about the current insurance space. Because insurance is a contact sport. Insurance is tested in the courts all the time, and insurance companies, when they lose a case, if it's a 50-50 and it goes against them, all across the industry, the language in those insurance contracts changed to reflect an exposure they hadn't anticipated, never meant to pay, and have then just moved on to excise from the policy. So I know we will cut it down on the list to maybe discuss later, but one of my favorite ways of telling when a lawyer graduated is if they use the phrase all risks in a contract or in an agreement. So all risks used to be the language on liability. So you take out a liability policy that covers for all risks. And it was understood until a court decision back in, I think, about 86 or 87, that meant all risks as contemplated by the insurance policy. Well, the judge who ruled on this must have had a terrible car insurance claim, or his garage burnt down or something, because he was like, nah, all risks means all risks. You wrote it down, you're going to cover all risks. And the insurance company's like, wait now, what? And we're on the hook for something that was never intended to be covered in the policy. So they changed the language. And now you'll see insurance, most contracts, at least US-derived insurance contracts, use the language special risks. And then it's a fantastically legalese way of looking at it. Special risk covers everything except that which is explicitly excluded in the policy. You know, well, that's a mile-wide gap they can drive a truck through, right? But what's great about it is the insurance company has to prove it's not covered, not the other way around. But there are a finite number of things it covers, right? And I will either cover it because the risk is too likely to happen, weirdly enough. Sometimes they will not cover it if they think that the exposure is almost guaranteed, or if they feel it's covered better elsewhere with a better product or a better contract. So flood's a great case in point. You're on the waterfront, 1 in a 100-year flood, that's not good enough odds for an insurance company to include on a standard property form. They guarantee they're just going to lose money. The actuarial tables show that they're going to be pumping money out across the nation, because flood is not just waterfront. Flood is an inundation of 2 or more acres or 2 or more properties. That's the federal legal definition of flood. So floods can happen anywhere. If the water main breaks in your neighborhood, that can be a flood. If you are, I was up at Sunday River, we had Brian He on, the GM up there, speak to our group, and he talked about the big storms they had in 2023 before the holidays. The river didn't come up, but their snowmaking system broke and dumped water down the hill. So that's a flood. That's gallons and gallons of water inundating more than 2 acres. So these are things to think about. That's better covered elsewhere, right? So be thinking about what your exposures are. Be thinking about getting advice around those things. And I'll leave this element with the thought that if an insurance broker or an agent or even a carrier is doing their job properly, it shouldn't be preventing you from doing something. It should be helping you set your comfort level with risk so that you can make informed risk and continue to grow your company.
That was perfect. You just answered my very next question on my list. But what I want to highlight from what you just said, Dan, is that I think it's easy to see insurance as like your enemy, as this person who's like charging you lots of money and then refusing to cover things. But in reality, insurance should be your partner, and they should be helping you figure out where your risks are, where your coverage is. I had never considered asking your agent to, read your lease, like what great advice, because that's risk management, and who better to advise you on that than risk management professionals. So really helpful. Use your insurance companies like a partner, have them help advise you so that you can make sure that these special risks are covered. And if they're excluded from your original policy, you can just add on an additional line of coverage sometimes. So having to make those decisions. So feels kind of overwhelming. Do you have any advice, either of you, on like what should we prioritize? Like what's a non-negotiable that if we can't get everything perfect, what should we absolutely not miss?
Do you want to start? Yeah.
So one of the things I often say as a to contextualize what insurance is supposed to do, and to help people understand the role it plays in your business. Insurance is many things, but it isn't a warranty on life, right? So certain things happen, they're not going to be covered, they're just not insurable, or they're not in the contract. But the one thing every startup, every business should really contemplate doing is making sure they have a general liability policy in place. And this does several things. First, so why not property? I've invested all my money's in my stuff, right? Well, the loss of stuff is finite. It's sad, it's tragic, but you lose a computer, you lose a desk. Worst comes to worst, maybe Grammy and Grampy can help you with a bridge loan, you get it done, or you've got good enough credit, the bank will help you out with that, or whatever it may be, and it's X $1,000. Under US tort law, liability is technically unlimited. So if you cause physical injury, physical damage, emotional anguish, emotional pain, false imprisonment, one of my favorite things that's covered. Don't go locking people in closets. It's a bad idea. But you do have insurance for it if you buy GL. General liability is designed to cover you in these tort claim situations where someone alleges that your actions, your inaction, your product, your completed operations, excuse me, have caused them harm in some form, and that you should be compensating them for that harm. And sometimes that can be a breach of contract. It could be a failure to deliver product. It could be all manner of things. But GL is where we see a lot of action and a lot of activity. We know this is a litigious country. We can go into the reasons why. Personally, I think it's a lack of single-payer healthcare. People need to get their support to get their medicine somewhere. But you do see these claims, and there's money to be made in the GL space from plaintiffs' attorneys and from investment firms who invest in legal settlement recovery. So if you get hit with a GL lawsuit, carrying $1 million of general liability is your defense that will keep your company alive, even against frivolous suits.
I was going to say the same thing, but I also would say it's doable. So I think that it sounds a little daunting, but it's actually doable, and the startups that we work with, for the most part, can take care of that. So you can scale it to the extent that you can, have some revenue coming in, but it's really important. It made me think of another kind of, you were talking a little bit, that made me think of another liability story, which is there was a company that I spent some time helping start up, which was a seafood company that was processing seafood here down on the waterfront. And eventually we were able to have, we refitted one of the warehouses down here, put some of our own freezer equipment in, took a year and a half to get a very specialized freezer from Japan installed. And then, had a series of outages where, so then you have your inventory, which is very expensive, your fish inventory that does perish. And we had, it has a life, a shelf life that's very specific. And if you have inventory that's sitting in there's any break in that chain of cold chain, you have a real long-term problem. So yes to general liability, and then think a lot about I would go back to inventory or assets like that really, in the end, are whether or not you make it to break even or you make it to cash flow positive, the things that are absolutely necessary. So we could have sales, but you could then lose your product, and then you are really in trouble. So, that's an example of a challenge that I would definitely pick up on. The only other thing I think that I've been exposed to, I don't know what your thoughts are, just as you start getting capital, if you start getting investors and you have a board, you have to have D&O, and you have to have directors and officers insurance. That's just, you're not going to have the right, it's hugely important. And I would recommend getting that as you get more established. A lot of early startups just have, voluntary advisors. Those folks are not liable, but once you have, an incorporated entity and you have other people's money in, and you have official board members, you need to have D&O insurance.
Yeah, those are really good points. And a quick note on both of those. Excuse me. So on that inventory coverage, the sort of breakdown of equipment coverage, so that's on the property side of things, which isn't just your stuff. You can also cover your income as well. So you can cover business income, the extra expense, perhaps to go rent another freezer somewhere else. is kind of that piece. And that's a good conversation to have with an agent to map out what those exposures look like. On the D&O, the directors and officers side of things, that's, again, really valuable because it will attract a better class of or quality of director. You're going to get a stronger, not that people you get, your friends, family, whatever, are terrible, but professional advisors look for this when they join a board. Excuse me. And the other side of it is it protects from internal fights. So it protects the members of the board. It also protects the entity from claims by the board alleging malfeasance or misbehavior between other board members.
Thanks. Oh, he's got water right here. All good. So I'm trying to think of what else would be kind of an area that I would focus on. I think those are the major ones. You have another one in mind?
Brilliant sip thought. As you bring people on as well, bear in mind too, you're going to have a statutory obligation to have workers' comp in place. It's not expensive, and in Maine we're very fortunate to actually have really decent workers' comp rates. So just make sure you're following the law in that regard more than anything else. I think circling back to close the loop on this, this is the general liability property side of things. If you are a relatively benign risk, so you're not, I don't know, doing atomic welding or something, you're fairly straightforward, not a huge amount of exposure. We can talk about that offline if you want, because sometimes what we feel is pretty straightforward, the insurance industry doesn't, which is weird still to me after all this time. But it's not hugely expensive. So if you're fairly benign, you've got like an office space and an incubator, you may be pre-product, pre-revenue, you're working along, you're going to get general liability and some property coverage for your laptop, a few bits and pieces, probably around about $500 for the year. So it shouldn't break the bank. Factor that kind of thing in. As your company grows, if your exposures are different, if you have more revenue, that's going to start to track up. But if you budget $500 to $1,000 a year for an early stage startup for your baseline insurance, that should pretty take care of it for you.
Great. Thank you for leading me into my next question, but I'm going to try and ask something to Blaine to give you a little bit of a breather here. So when we think about these different types of risks and pricing, are certain areas or certain industries less insurable or cost more? Because, again, coming from Florida, our insurance feels like it's going, like I'm not paying at that $500 level. Unfortunately, it's on a much larger scale than that. So how is climate specifically, but how is that affecting like accessibility to insurance coverage and pricing?
So I'm going to start kind of generically, and then I'll let Dan get really concrete about an answer to that. But I would say we all recognize, and any of us that have property or working on or near the coastline, recognize the environmental risks that we're starting to see. And we're seeing, at least I'll say as a layperson, I'm seeing insurance companies pull back, radically increase coverage costs, in some cases deny coverage, just basically say we don't insure that any longer. So you may not have had flood insurance, or you may have had it, and then they say you can't have it anymore. So we're definitely seeing that. I've heard horror stories about what's happening in LA right now on the fire side. I'm sure you can talk about that. So that definitely is an issue. I do want to point out just, and maybe we'll get to this in a minute, but I want to put a pin in this. There is a lot of really interesting new technology that's coming in, and I'm sure you wanted to talk about that at some point, but there are things that we can do to better understand the risks of the property we have, and addressing this. If you're a larger company and you have assets that are on the water, or that you need to understand better your not just today risk, but predictive modeling towards future risks. There's some really interesting companies coming along and technology coming along that that I'm seeing that I think is fascinating. And I would think the insurance industry would want to pick up. This is one of the interesting debates that Dan and I have had, is who the market is going to be for those software products or those predictive modeling tools or the ocean data that will actually help us better understand when we're going to get inundated, what properties are going to have problems, what erosion issues we're going to have, how do we mitigate those. There's a lot of stuff coming. And I just want to make sure we get a conversation going about
Oh,
that.
yes, I want to hear this debate.
But let's get Dan to tell you,
Yeah.
what the, sort of really
let's
answer the
stay
first
low
the
for a
first
little
low
bit.
question
Yeah.
first. So
Yeah, low energy, bad stuff, scary stuff. Climate change is really affecting us, and then we'll end on the high note. Yeah.
There you go. So I think where you do see issues. Well, let me back up. I've always said that if the insurance industry had the size and heft of the fossil fuel industry, this wouldn't even be a conversation because we're paying for it, and we're paying for climate change every day and with increasing frequency and regularity. Where you're seeing issues are, in the US at least, are in states where you have a climate plus problem. And in the cases of California and Florida, you have a climate plus regulatory issue. And in Florida, you also have a climate plus fraud issue that has been driving insurance out of the country, out of the state, uh, even prior to the most recent storm activity or fire activity. In Florida, for example, it's gotten so bad that the state insurance regulators allowed a 60% increase in property insurance premiums, and companies still left because they couldn't make it work mathematically. There's just so much exposure, so much value concentrated in places where it shouldn't be concentrated. And until very recently, Tallahassee had a thumb on the scale from the construction industry around roof replacement and elements like that, that really put the onus on the insurance company to fund improvements on the edge of storm areas as well as repairing real serious damage in communities that have been devastated, which I'm sure wasn't the intent of the legislation, but that's what was happening. In California, you had a situation where until January 1 of this year, ironically, predictive modeling was not allowed in mapping fire risk. You could only use prior data for what had happened in that area. So as conditions changed, as climate changed, accelerated fire risk, and these whiplash weather systems where you have very wet periods that cause a lot of vegetation to grow, then very dry periods that kills that vegetation and creates a mass of tinder and burnable material. And you have a population spilling out into, frankly, areas where humans probably shouldn't be living, but we've got the technology to make it possible. I mean, if they're helicoptering in the elements for your house, probably not an easy place to defend in case of a fire. But you couldn't use any of those factors in pricing insurance. So you had insurance companies leaving the state. And you'll hear people say, my insurance turned me down. Well, when? After the fire? No, they canceled me last May. Yeah, because they could see what was coming. So the good news is, in the Northeast, we're not there yet. We're still grappling, even with the more disrupted weather patterns we've seen, with the more intense storm activity we've seen, especially last January and March with those huge events that did so much damage to the coast and coastal infrastructure. What we're seeing are things like wind deductibles. So if your normal deductible on your property is $5,000, they'll put a named storm deductible of $25,000 or maybe even 5% of the value of the building. And that's how insurance companies are mitigating their risk in the Northeast. There's also a few of us who are fighting a rearguard action at every gathering of agents and companies that happen. They have councils. We go sit and we advise as the field force on what's happening with their customers. And several of us along coastal Maine and New Hampshire who fight all the time about wind deductibles and ratings for storm risk in the coast of Maine. It exists. But again, another pop quiz. Does anyone know which state in New England has suffered the most hurricane damage in the last 30 years? You heard me say it the other day, huh? Shout it out. Vermont, yes. Oh my God, everyone goes, well, how does Vermont have hurricanes? Well, they come up through the center of the country. They flow into western Vermont. The topography there, the way the hills, the valleys, the rivers work, causes accelerated damage with there's a lot of rainfall or issues. And it's water that causes damage in storm, folks, not wind. That really is what the issue is always. And these rainstorms just deluge Vermont. We got the Gulf of Maine is still a pretty decent heat sink. It sucks the energy out of these big tropical storms as they come through. And we get a glancing blow once in a while, and I dare say we will get a big one day, but the chances and odds are likely that we won't. So these are the things to look out for. Think about where we are, what's going on, both climatologically, but also in a regulatory basis. Is my state government, is my local government supportive of climate adaptive policies that are going to lower my risk?
So I'm going to lean on you to tell one more story. When we were talking about doing this event and I was complaining about how horrible the hurricanes were in Florida, you were like, no, the hurricanes were horrible for me. Listen to this. And there's so much climate action happening around the world that month or those couple of weeks were not just storms in Florida. They were storms and catastrophes all over the world, geopolitical stuff, climate stuff. Can you recount part of that story about
So-
why is this so impactful for insurance?
Right. So I've always said that insurance is probably one of the most socialistic capitalist tools out there because it's about pooling risk and mutual sharing of exposure. So your premium goes into a pool, some of which insurance companies invest, but some of it they have to hold by law, and that's how they pay claims. So it's the deal, the bargain, that if your neighbors are all part of the same insurance company, let's say you all pay in and you're the one who has the fire, the premiums that everybody pays are the elements that cover your exposure. You may feel you're paying an extortionate amount of money. I'm paying $5,000 a year for my home insurance. Well, your home's worth 1.5 million if you're in Cape, right? So for $5,000, someone's willing to stump up 1.5 if that thing burns down. Where's that money coming from? It's coming from pooled premium. If you extrapolate that out to risks around the world, you have companies that are taking on risk in Maine, but they're also taking on risk in Kansas or in Belgium, or they may insure vessels. They may insure port infrastructure in Florida. And so the one I think Tara's referring to, I happened to be in London at Lloyd's the day of the second, it began with an M, hurricane in Florida last year. It was also the same day there were two guided missile attacks on tankers from the Houthis in the Red Sea. And I sat in the office of this particular insurance company as they were breaking out their calculators and figuring out if the storm hit the port of Tampa, how much additional money they'd be paying out by lunchtime that day, in addition to the two vessels that had taken fire in the Gulf. So these things are happening, a confluence of human inputs, climatological inputs, which is ultimately human input, that is driving risk to levels that is almost is becoming unsustainable and extremely expensive. And because it's a mutually based system, we're all going to pay for it. So that's the thing we have to bear in mind is like, my goodness, it's expensive now, but if we don't arrest some of these things, I don't want to think how expensive it's going to become.
Yeah, that just really helped me understand the complexity of this issue. But now that we've talked about how expensive it is and how much scary stuff there's going on, why we need all this coverage, let's talk about the future and what climate tech can do, what tech can do, what innovation and data science can do. Let's talk about data first. Here we are at the Rue Institute. We've got data researchers, data students. What are some of the possibilities of using this data to help inform?
Yeah, I'll let Blaine be the dream weaver, and then I'll come and be the dream crusher.
This is why we like each other, because I like to argue with Dan about this. But anyway, so this is something that I've gotten a lot more exposure in the last couple of years as we've been looking, not only as we're seeing this increase in climate and weather impacts, but also getting into the space of, in my case, the blue economy and the ocean side of the house. So I can't speak so much to what's happening terrestrially in terms of data, but I suspect it's the same thing. We are really beginning to see an emergence of synthesizing of the data that is available in the ocean and also trying to collect more information. So there's countless organizations and startup companies trying to deploy equipment to collect data, surface to bottom. And think about just, we don't really have the same level of weather service, if you will, of what's happening conditionally in the ocean in a unified way. We have a lot of scientific information that's disaggregated. And so we're starting to see, and this is one of the things we saw in the program we ran last year with the Rue, and it was called the Blue Wave, which was an AI and climate accelerator. We had some companies coming in who were trying to integrate data for predictive modeling purposes. So it's one thing to actually collect the information. The other is to actually make it possible for decision makers to change their behavior. So to give you an example, if you're an aquaculture farm and there's a super chill event, or there's a coastal storm coming, do you need to move your equipment? And one of the challenges with climate data and science data over the years has been that the interval of time to be able to predict what occurrences of problems is usually much longer horizon than the actual operational time window is needed. So what we're seeing is a compressing of the time that and the ability to predict occurrences of storms and impacts that allow decision makers to change their behavior and avoid risk. We're beginning to see tools, and you can talk more about what parametric insurance is, which is a term I had never heard until a couple of years ago. So things that actually allow companies to avoid risk and basically be compensated for not incurring a loss. So those are the kind of things we're seeing. So an aquaculture farm having data to be able to change its behavior, companies beginning to see. There's a company I just met last week in Tokyo called Ocean Ledger. I'd never met them before. They use geospatial data, so they're using satellite data to do analytics on coastal infrastructure. So they can actually tell someone who has, say, it's a large hotel chain that has substantial assets in some location, they can not only quantify what their current risk is, but they can also track erosion, risks of large property and their assets. And the idea would be that not only, say, an engineer that's building new facilities could use that data, but also the hotel management company could use it. Then, and ideally, ultimately, underwriters would use that information to be able to quantify and qualify insurance for large assets and properties. Inundation tools. So there's just tons of things happening, and AI, I think, will be a component of that as we have massive data sets. And I think the only other thing I would underline is that it's predictive modeling, because we can't rely on what we knew before, and that's back to what Dan was saying. Because of climate change, you really have to use data science and predictive modeling to anticipate what might happen, as opposed to relying on historic information. So that's why this change is happening right now, is that the data science is coming along, and the aggregation, integration of data is coming along, and the deployment of AI is coming along, such that you can actually model this stuff in a more integrated way for decisions.
I think, Blaine's spot on all of that. I think the real question becomes is who is the ultimate end user, right? And I think where my Oscar the Grouch thing comes in a little bit is we can't assume that insurance is going to use it or that it's going to benefit customers of insurance if they do use it, right? So a couple of things. I mean, Blaine's case study there about a hotel thinking with multiple coastal properties, thinking about their erosion exposure. That's perfect. That's a great end user. That hotel chain, that hospitality company should be the customer. We show that to the underwriters. We just confirmed something they thought might happen is probably going to happen. All right. So until we can get from A to B on the mitigation strategies and those are implemented, we've actually just made the risk worse by sharing that information. Doesn't mean we shouldn't share it, because that's useful information. But the likelihood, what I'm saying here, and we've seen this, I don't think if Californian insurance companies had been allowed to use predictive modeling, that they'd have been, oh, okay, Pacific Palisades will stay here all day long. They would have got out faster. And I think that's what the legislature was looking at. And that's why they weren't allowing it until it suddenly became a self-fulfilling prophecy and companies started to move. I think there will be a gap in time. There will be a period certain where insurance companies will continue to pull the biggest lever they have, which is what we call a reduction in appetite or leaving a market, right? So either they'll do less of something because they feel there's too much exposure, too much risk, or they won't do it at all. We're starting to see that a little bit with summer homes on the islands in Maine, where you got a lot of frame construction and what we call a PC9, a protection class 9, where you're hoping the Portland fireboat makes it over or the volunteers weren't all at a barbecue, right? And so that's where you're running into issues, because you've got a $4 million home that's wood on an island that's had a really dry summer. Doesn't look great. So more data may not necessarily mean more access when it comes to insurance. And when it comes to buying the data or working with the generators of the data or the aggregators of the data or the interpreters of the data, that's happening higher up the chain because of the way we structure insurance in this country. We do have national companies, we do have companies looking at this, but there was a great financial regulatory divorce in the 1920s where banking went federal and insurance stayed with the states. So there are 50 regulatory bodies on insurance companies, and they have plenty of times trying to keep up with all the rules and regs and everything else, and depending on where you are, there's also some federal jurisdiction as well in certain spaces. So the folks who are making the decision-driven elements around climate change, around the use of technology, around adopting and investing in smart new processes and procedures and companies is mostly Lloyd's out of London. which is actually a market versus one company, but they do a lot of stuff collectively. Again, back to the joys of socialism in insurance, big fan. And the reinsurance companies, who are the firms that insure the insurers. And again, there's some in the States. A large amount of that capacity is in Switzerland, Germany, the UK, France. And that also becomes a challenge. So I think I told you about my argument. I always have Vermont versus Maine, who's got the most hurricane risk. You start moving 1,000, 2,000, 3,000 miles away, and you're not talking about it in Boston with the insurance company carrying the risk, but you're trying to talk about it in Hamburg with the reinsurer insuring that insurance company. They just see New England, they don't care. They're going to slap a $25,000 deductible on there. So that's what we're dealing with. Keep plugging away at it, but don't assume that the insurance industry are the ones who are going to open the wallets.
So I think this is a really important, for any of you all who are in the startup space, thinking about your market. Obviously, you want to get to your market and identify your first customers. And many of the companies that are in the ocean data space that I've been working with, one of the key markets they have identified or they continue to emphasize is that this is an obvious place where the insurance industry should be a buyer. You know, when you have more information, more data, it seems obvious. And I think this is why I've had such a really enlightening conversation with Dan that's ongoing, is when will or in what scenario would the insurance industry become a market? The other market that folks have really emphasized in the ocean data space has been the offshore wind market. Because you're obviously looking for large industries that would have a reason to understand condition changing, things that would affect operations, anything that has to do with coming back and forth off of the water. And that industry right now is really effectively on hold due to the obvious stuff that's happening in DC. So if you're in that startup space, you've really got to think about who that market's going to be and who your first buyers are going to be. So I appreciate that you thought the hotel scenario is a reasonable one, and I think you need to think about who actually has the capacity to pay for those tools and products that you have to find that substantial buyer. And so we have this challenge, and this is something that's being talked about across the startup sector in ocean, is we have all this environmental data that we're beginning to synthesize, and are there, even though it's providing tremendous information, are there going to be buyers for that data in the near term? Unclear. It's unclear. Yeah.
I just had a thought, way to frame it. A lot of the stuff that we're seeing and we're talking about, and I get approached quite regularly about making, who should folks talk to in the insurance industry, because they've got this fantastic tool that can help somebody or an insurance company analyze data or understand a certain set of parameters or whatever it may be. Reminding me of parametric insurance, we'll talk about that. Is we've got to figure out how to help. If you want to help get an insurance company interested, it's not enough to say, I can provide you data that can give you a clearer insight, because there's a lot of that out there. How can they turn that to profit? How can they take your partnership with them? How can they take the information you're providing them and turn that to their advantage to generate more revenue? If they're a mutual, for their policyholders through dividends and through savings, if they're a stock company, for their stockholders. And that's really what the question needs to be, is how are we going to be able to use that data, not just in a defensive crouch, but enable them to be more effective at what they do to generate more revenue? And it's not, so that's not just pulling out of areas of high risk, it's how can they do things differently? So there's something to think about. And that there's a nice segue into probably my last thought, which is, Blaine had mentioned it earlier, the concept of parametric insurance. So parametric insurance is an emerging field. Started out a lot in crop insurance, and in fact, the UN and the USAID were great proponents of this around crop insurance for developing countries or second-tier economies. Parametrics is just what it says. It takes a set of parameters and insures for those specific risks. So if we take a hurricane risk, it's going to be, rather than buying a policy and you pay, if you can get it, $25,000 for this policy, and it's covering everything from one pan tile blowing off your roof to a force 5 coming through and taking down the whole building, you can drill in on that really extreme risk. You find, I'm fine, I'm going to cover my little bit of minor roof damage. I want specific insurance for a category 4 hurricane coming through and with wind speeds of this, that, and the other. And that you can actually set a more tailored product pricing for. But you've got to have the inputs to understand how to set the parameters. And so it's been kind of a broad brush product, a crop-based product across whole geographic areas or ecosystems. And now it's becoming a much more tailored tool for specialized risk management. So that's where big data, or granular data even can be very helpful. But we've got to figure out how to get there.
Awesome. So I'm going to kind of highlight a few of the takeaways that we've talked about. We've talked about a lot. I skipped a lot of questions, so hopefully they'll come up in the Q&A. And then I'm going to turn it over for Q&A for a few minutes, and then we'll get back to networking. So the big takeaways that I heard is that first, insurance is your partner. So be proactive, talk to them, have them help you, and understand your special risks. Second, at least have general liability coverage and whatever else is legally required by law. And third, if you're going to think about data and AI for innovation as a startup and want to work with insurance, focus it on how you can make them money, not just how you can provide more information, because information is power, yes, but not necessarily for the startup. So I'd love to turn it over for questions, but any last thoughts before we do that? Okay, great. We have one online. Mike, can you introduce yourself before you ask the question so we know who?
Hi, thanks. I'm Mike Smith. I'm with Wilmington Trust. We work with a lot of founders, venture capitalists, et cetera. I'm curious, and I'm wondering if you could say a bit about the sort of digital cyber risk insurance capabilities for companies, to protect against hacking and which can basically destroy a company. It's not really property casualty related, but I know there's been some developments in that area, and I'm curious where that is now.
Actually, when you say property casualty, you hit the nail on the head, because a cyber suite policy will have both property coverage and liability coverage in this. So exactly to Mike's point, right? So you got yourself set up, and then suddenly someone clicks on a fictitious link, and you find yourself in a world of hurt. You've got two things going on there: probably damage to your own systems. They need to be unlocked. They need to be negotiated to be released. Worst case scenario, if they brick the systems and their software completely destroys your hardware, you need to get that replaced. And then you've got liability elements. So with a hack or a breach of any kind, there are regulatory elements that you have to comply with. You have to notify your customers. You have to notify your employees. You have to provide credit monitoring in certain situations. So there's coverage available. We recommend, as a matter of course, well, I'll go back a little bit. So 10 years ago, when this really started becoming a serious issue and a serious product, there were very specialized products. A couple of years after that, insurance companies with a more broad-based footprint felt, well, we can make money on this, but we don't want the exposure, so we're going to put some cyber into a basic policy. You can pay a little extra for it, but it's really limited coverage. We'll put $100,000 for a total and $10,000 for this, $10,000 for that. The cost of recovering from a breach or a ransomware incident or a phishing incident can be quite substantial. I don't know if anyone saw the news down east last week. Bar Harbor is just working on building a new elementary school and had bonded the money and was sitting in the municipal accounts for the school district. Fictitious actor took $1 million from the school district by breaching. They got a hold of the contact information, spoofed the contractor, changed the bank account information. Well, in this case, they were able to recover the most of it, but quite often that money goes away. And so covering for elements like that, having enough insurance that takes care of those issues. The good news is, if you have controls, if you're smart about it, if you're using MFA and other kind of protections on your remote operators, all the rest of it, it can be pretty affordable. The challenge comes is when you're like, that'll never happen to me. I have to have it. I'm not doing this, that, and the other. Then you find yourself paying a ton of money.
I'm just going to add a little kind of story that may be not relevant to the actual insurance side, but the proactive protection side. At least the data that I've heard is that the risks are typically from your employees. That's where the risks are 90%, more than 90% coming from. And there's some interesting software companies out there that are actually helping with preventive information. We were using one at GMRI. I thought personally, I was like, yeah, I understand this stuff, and I'm definitely not one of those people that's going to have a risk. And there's a company called Defendify that's a Maine-based company that's a startup that we started using at GMRI, and we had required employee. They're basically like little videos, and you do go through training exercises, and the entire staff had to do this. And I can tell you personally, I learned a lot, and definitely they test you basically, and you get screwed. Sometimes they they'll throw you an email, and I think I had an Amazon package or something that was supposedly not being delivered, and I clicked on it, and they're like, yeah, we got you. So they do tests, but they also do educational videos. And I'm a huge proponent of that. If the next place I worked, I would say put something like that in place, because it definitely decreased your risk. And we had 90% or 99%. Our IT department was making sure everybody was following along and complying, and you get a little certificate. But I learned a lot, and personally, I learned a lot for my own protection, but also I think our company's risks went way down as a result of that. So I don't know if you advocate things like that, but yeah, I was impressed, and I would definitely encourage people to use it.
To that point, we do that internally. So we do those penetration tests, we call them. And one of my colleagues famously called it, we're going to play Matrix today. They were super excited, but it is fun. And I recommend that kind of blind testing piece. Again, whoever your ISP is, they can probably recommend somebody. Defendify is a great firm. Systems engineering here in Portland is also really good. And they can kind of help you with that as a partner to be your kind of first line of defense.
I have a question from Rose Nelson from Maine Redevelopment Land Bank. And it is, how much, if any, of climate risk would be covered by a business interruption policy?
Well, it's the classic insurance answer of it depends, because it's based on the actual policy language. But if we take a classical model business interruption policy, which is something happens to your property. So first of all, business income is a property loss. So there is a flood, you cannot access your building, your inventory is destroyed, you have lost property, the clock starts ticking on the money you would have made from that facility or from that inventory. After usually a time element deductible, anywhere from 24 to 72 hours, your insurance will kick in and replace that revenue. Couple of caveats. One, they will look at it from a forensic accounting standpoint. They're going to look at what you did that time last year or what you were projecting, and they'll work it through. The second thing is if it's a covered cause of loss. So if it's a windstorm, if it is, if you have flood insurance, you can get BI on your flood, business income on your flood coverage. If it is a wildfire, your building burns down. If it is a covered property loss, it doesn't matter if it's climatologically caused or by some lunatic running around with a can of gas, it's going to be picked up and the BI is going to kick in.
Great. I'm going to do one more question, and then we'll open it up to networking. And if you guys can hang out for a few more minutes, then hopefully everybody will get their questions asked.
Great, thanks, guys. I have several questions, but I'll just stick to one. Nick Planson with Shred Electric, the Boatyard LLC, and Sea Meadow Marine Foundation. So we've had a few experiences, whether it's at our family business or one of the ventures we're currently operating, where you think you're covered, your agent told you you're covered, your policy is specifically for the thing that happened, and then it turns out you weren't covered for that, for some particular nuance. So what's your advice on what can kind of seem like this endless loop of you first ask the lawyer to expensively review something, and then the insurance policy gets in place, but then I'm learning you should have the lawyer then read the insurance policy before you sign it to make sure that the wiggle rooms are very understood, so that, like the online scam thing, you can think you're very well covered, but then if it happens slightly differently, you're not covered.
Yeah, I don't know the specifics, obviously, of your claim scenario there and what happened to your particular company, but a couple of red flags went off in my head as you were talking. One, you sort of blithely say the agent said it's covered. That's something you really want. A good agent probably shouldn't be doing without having read the policy and reviewed it with you and run through scenarios. The second thing is we should have the lawyer read the insurance contract. I refer you to my earlier answer. Lawyers are good at many things. They may not have a huge grasp on insurance. So in tandem with your agent, assuming you've got an agent you like and you trust, they should work on that with your attorney. That's something we do as a matter of course. We have relationships with most of the firms, larger firms in Maine, and pretty good ones, and we have some pretty good back and forth. And again, it is that contract language, but if you feel like that it should be covered and it hasn't been covered, your agent should also be an advocate for you. I'm not saying this was the case in I don't know your agent, and I'm not going to speak ill of them, but if anyone runs across an agent when you have a claim and at the first hurdle, you think it should be covered, they pretty much said to you, well, we think that should be covered, and the company says no, that should be the go sign, not the stop sign for the agent to engage with the company and have that conversation. Two things which seem kind of counterintuitive, but it's going to be in your best interest until it gets really, really gnarly with an insurance company. Don't lawyer up. Don't hire a public adjuster. Personal opinion, but those will be my recommendations. Those two things, if you want to slow down a claim to molasses and get yourself tied up and really put an insurance company on the defensive and not want to work with you, those two things out of the gate are going to be the things that really chew things up. Instead, lean on your agent, lean on the adjuster who's coming to see you. Don't sign the first thing they give you, and have a conversation about what's really covered and what the issue is. And if they say it isn't covered, you want to make sure that's fully laid out and with reference to the elements of the policy they're talking about. Because then if you do have to go to an attorney, you've got them telling you what their basis for defensive, which is something they can pick away at and hopefully get it resolved in your favor.
Very good advice, and kind of brings us full circle to this conversation of really lean on your insurance as a partner, and have them help you. Easier said than done, of course, but very good advice. So thank you, Blaine. Thank you, Dan, so much for joining us. I feel like we might need a part 2 at some point. I think there might be a few other questions that people want to ask you, but we are going to end the Zoom part of this meeting. Our Zoom participants can also reach out and we can pass along questions or make connections as we are able. So thank you so much. Thank you everybody online, and we will see you at our next speaker series.
Thank you.
Thanks, everyone.